One way to build wealth over time is by investing in assets that can grow in value and are not taxed annually. This concept is known as deferral, and it's one of the most powerful tax minimization strategies used by the Greenard Group for helping you build wealth. If you're in the upper tax brackets, often you have few options to avoid tax. If you cannot avoid tax, the next best option is to defer tax. One method we'll explain is to purchase assets that appreciate in value and you don't plan on selling them. If you've reached the top marginal tax bracket, we'll always recommend creating a portfolio of high-quality assets that will generate deferral. Deferral occurs when you shelter tax funds within registered accounts. Deferral also occurs when you buy assets in non-registered accounts that appreciate in value and you do not sell them. You could hold assets for decades and the market value could be substantially higher than the original cost, and this is known as adjusted book value for tax. The difference between the original cost and the current market value would be considered an unrealized gain. Taxes are not payable until an asset is sold and the gains are realized. By holding great assets for the long term, the taxes that are payable to Canada Revenue Agency can be deferred right until death in some cases. One of the benefits of dividend-paying equities is that they offer income but also long-term growth potential. When we buy high-quality equities for you, in many cases, you'll hold these for your entire life. If you buy a stock and don't sell it, you have deferral. Only once you sell the stock do you owe any tax if the equity was in a non-registered account. Non-registered accounts are taxable accounts, and this can be an individual non-registered account, a joint non-registered account, or a corporate investment account. Non-registered accounts do not offer any government-created tax shelters like registered accounts do. It's important to pay close attention to how investments are taxed within these taxable accounts, because what ends up in your pocket after tax matters the most. To illustrate deferral, let's use an example. Let's say you purchase 300 shares of XYZ company for $200. This is an initial investment of $60,000. 10 years later, you did not sell one share in XYZ company. The stock price is now $600, and the market value of your position is $180,000. This represents an unrealized gain of $120,000. Over the 10-year period that you held XYZ stock, you did not pay any taxes. This is deferral, and results in the least amount of taxes paid, which in this example is zero. If instead you sold some XYZ every year, since it's in a non-registered account, you'd have to pay tax every year on the gain on your position. As a result, your investment would be worth much less after tax. Every year, the net amount that you put back into XYZ stock would be less. Buying and holding great equities takes advantage of the benefits of deferral. Registered plans, like the Registered Retirement Savings Plan, also take advantage of deferral. When you contribute to a Registered Retirement Savings Plan account, you receive a deduction from your income. For example, if you earn $100,000 and contribute $20,000, you'll only be taxed on $80,000. This deduction, created by the contribution, produces tax savings today. This is the first layer of deferral. You delay paying taxes on the contributed amount until you withdraw it in the future. The money is invested within your Registered Retirement Savings Plan, and any income or gains within the plan grow tax deferred while they remain in the plan. Since you're not taxed on any investment income, more money stays invested and compounds over time. This is the second layer of deferral. Contributions to a Registered Retirement Savings Plan are made during your working years and when you're typically in a higher tax bracket. Withdrawals are made in the future, ideally when your tax rate is lower. This allows you to pay less tax overall on the same dollars. By deferring tax, the full amount of the contributions made into the plan and all earnings within the plan remain invested and compounded over time. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.